WeWork was no ordinary company, and this is no ordinary story. It took rented desks and free beer, wrapped them in a utopian sermon, and sold that vision all the way to $47 billion. In 2008, Brooklyn real estate was hurting, and Adam Neumann needed a business that could pay rent, not just impress investors. Neumann, an Israeli-born founder with salesman instincts, had already tried baby clothes with knee pads and learned charisma was cheaper than inventory. His partner, Miguel McKelvey, brought the opposite energy. Quiet, design-minded, raised partly in a commune in Oregon. Together, they opened Green Desk inside a warehouse in Dumbo, carving eco-branded offices out of industrial space. The model was simple and dangerous. They signed long leases, renovated floors, then rented desks and small offices by the month. That gap mattered because a lease locks you in for years while members can leave in weeks. Still, the rooms filled. Freelancers liked the polished wood tables, the fast Wi-Fi, and the low hum of ambition bouncing off brick walls. Green Desk sold, giving the founders cash and proof that community itself could be packaged. In 2010, they tried again in Soho, this time under a name that sounded less like property and more like a movement. They called it WeWork, and the word "we" did half the work before the doors even opened. But a good name can hide a fragile business model, and that fragility was about to meet Silicon Valley money. By 2011, WeWork was no longer selling desks. It was selling belonging, and belonging priced better than square footage. That mattered because New York landlords understood rent, but venture investors paid premiums for stories that sounded like software. Each new location was staged like a clubhouse. Glass walls, reclaimed wood, kombucha taps, and long tables turned offices into a lifestyle set. The company called customers members, a small word that changed the emotional contract. A member does not simply rent space. A member joins a tribe. Neumann took that language everywhere, talking about energy, mission, and the future of how people live and work. Investors heard a founder who did not sound like a landlord. He sounded like a prophet in sneakers. Money followed, and WeWork expanded from New York into other cities with the speed of a software rollout. But software scales by copying code. WeWork scaled by signing more leases, spending more cash, and betting demand would always outrun obligations. By 2017, growth itself had become the product, and Adam Neumann needed a backer willing to fund expansion before the numbers made sense. He found one in Masayoshi Son, the SoftBank founder famous for placing giant bets on founders who promised giant futures. Their meeting became startup folklore. Sun reportedly urged Neumann to think much bigger, and bigger was exactly what Neumann wanted to hear. SoftBank poured billions into WeWork, turning a fast-growing office company into one of the most valuable startups on Earth. In January 2019, private investors valued WeWork at $47 billion. That number changed the company from a business into a spectacle. WeWork rebranded itself as the We Company and pushed beyond offices into schools, apartments, and corporate mysticism. The mission grew stranger. Its S1 would later say the company existed to elevate the world's consciousness. Meanwhile, the economics stayed brutally physical. Leases, construction bills, furniture, and buildings that could not pivot like an app. Employees saw private jets, lavish parties, and a founder whose personal mythology was becoming part of the balance sheet. Then came the one ritual hype cannot avoid: the moment a private story must survive public scrutiny. In August 2019, WeWork filed to go public, and Wall Street finally got to read what venture capital had been funding. That was the danger, because an IPO prospectus turns charisma into paperwork. The numbers were hard to romanticize. For 2018, WeWork reported $1.9 billion in revenue and a net loss of $1.6 billion. The filing also exposed governance that looked less like discipline and more like a founder monarchy. Neumann controlled the company through supervoting shares carrying 20 votes each. Investors then found the related party deals. WeWork had leased buildings partly owned by Neumann, blurring the line between chief executive and landlord. It had also paid him for the trademark "we," a payment later returned after criticism. The pros did not help. "We dedicate this to the energy of we," the filing said, while public investors hunted for unit economics, profit per location or desk. Suddenly, the gap was visible. WeWork was priced like tech, operated like real estate, and governed like a court. Once that spell broke, the $47 billion valuation stopped looking visionary and started looking absurd. By September 2019, the IPO was collapsing, and WeWork was running low on the one thing all stories eventually need: cash. Banks and investors pulled back as the valuation fell with shocking speed. Neumann stepped down as chief executive under pressure. SoftBank assembled a rescue package to keep WeWork alive and prevent a deeper wipeout. The man who sold community at global scale walked away with an exit package and a reputation in ruins. Inside the company, the mood changed from evangelism to triage. Layoffs followed, and the language of consciousness gave way to occupancy, costs, and survival. Then the pandemic hit in 2020, attacking the business at its most vulnerable point. Offices emptied. The sound that had sold the brand, the busy murmur of people building things together, was replaced by silence and cleaning crews. Remote work stopped looking temporary. A company built on dense, shared space now faced a world suspicious of shared air. But the deeper damage had already happened, because the market had learned what WeWork really was. In November 2023, WeWork filed for Chapter 11 bankruptcy in the United States, a formal admission that the old model could not carry its promises. Bankruptcy does not always mean death. Sometimes it means the story shrinks until it fits the math. WeWork emerged from Chapter 11 in 2024 with less debt and a far humbler profile. The miracle story was gone. What remained was a real business serving a real need, just without the incense of inevitability. That is why WeWork still matters. It revealed how easily modern capital can confuse branding with economics and spiritual language with operating leverage. Operating leverage sounds technical. It simply means your fixed costs stay put while revenue swings, which is dangerous when rent is locked in and customers are flexible. WeWork did not invent shared offices. It invented a more seductive packaging for them, and packaging was enough to move billions. Today, the company still operates more than 600 locations worldwide, a reminder that the dream was not fake, only priced as if dreams. Today, the company still operates more than 600 locations worldwide, a reminder that the dream was not fake, only priced as if dreams never break. WeWork's rise and fall was never just about one charismatic founder. It was about what happens when a rent-heavy business gets valued like software and narrated like a spiritual revolution. Today, the company still operates more than 600 locations worldwide, proof that there was always a real business underneath the theater. The mistake was believing the theater was the business.